Welcome back, traders and investors. I'm Rob Hoffman from Become a Better Trader, here to go ahead and show you more key tools and techniques that you must know as a professional trader. Okay, gang, well, what I want to do in this video is talk about the support and resistance break trade, also known as the 2-bar break trade, or sometimes referred to as the 5 to 7 bar rule trade by my student family. Basically, what this is, it's a combination of a couple of different types of tools to identify on more of a swing trade basis. This is a tool that I personally developed from more of a swing trade analysis perspective for both stock and options trading. Now, to be clear, the same concept can be used on an intraday basis with major support resistance levels, but it is typically used most effectively from my perspective from a stock and options perspective on the daily charts and just and weekly charts for that matter. So with that being said, I just want to go ahead and talk about the basic premise behind it. What it is, we go ahead and identify a key support or resistance level, and in this case what we have is the $1.60 level on the British pound. This $1.60 level for the last couple of years actually has gone ahead and been a key support and resistance level. So what we're looking for at this point back in time, and this is kind of a real life example that we were following through on, so I want to kind of do that with you here now again and kind of look back at that analysis. And what was happening was we had a 1-bar break above this key resistance level. Okay, so it had already been a resistance level back in time, and we had a 1-bar break. And this, what do I call 1-bar break? Well, I'm looking for a bar that opens below the key support level and then goes and closes above it, and ideally opens fairly close to the low of the day and closes fairly near the high of the day. Okay, so not a bar that goes and ends up closing way back down here like a 50% bar, almost like a distribution bar, for instance. Really want to close up near the top. Then I'm looking for the second bar to go ahead and continue that journey, opening up near the low and closing up near the high. If I go ahead and get that, that's what I consider, those two consecutive bars there, I consider that to be my 2-bar break. What does that mean to me as a trader? What that means is, as soon as we go ahead and revert back to that $1.60 level, which was resistance, my expectation is that we'll hold this support and I can look for long side trades at that former resistance level, now support, expecting it to continue on. And you see that's exactly what happened here. We went ahead and had the 2-bar break through this area, pulled back to that $1.60, bounced off it very nicely for several hundred ticks, came back to that level multiple times over the course of the year here, and went ahead and actually would come back to that level. All right, so and then after this, can't see it into the future, but it did go ahead and bounce off again. The thing to keep in mind here is that if we get that 2-bar break, that what was resistance now becomes support, and vice versa. Had it been a 2-bar break down to the downside here, I'd expect if it came back up there, it would be resistance. What happens though, you remember that was the 2-bar break side of it, but then I mentioned the 5 to 7 bar concept. What that is what happens if you don't get the solid 2-bar break. Often you won't get a solid 2-bar break. You'll get 2 decent looking bars, but 1 bar may close 50% off the high like we talked about, or close well off it, maybe 30% off the highs or so, so not a very attractive looking bar. That's where the 5 to 7 bar rule comes in. And here's what happens with that. If we go ahead and have gone and pushed above the key support or resistance level, in this case resistance level, and then even if we didn't have the 2 nice solid bars back to back, if we can go ahead and have at least 5 to 7 bars that trade above that key support level without going ahead and breaking back through it, then when we do get down to it, I expect it's going to hold. Well, what's the difference between 5 and 7? Why 5? Why 7? Well, if we go ahead and only hold above 5 bars, but we have rising support, for instance, like this rising 20-period moving average, if we have rising support underneath us and it pulls back within 5 bars, then I'll look to go ahead and still actually take that same exact long. However, if we go ahead and we only have 5 or 6 bars and we're pulling back, and we don't have a major support level coming underneath to kind of support it. So basically what I'm looking for is some extra confirmation is what it really boils down to. So if we don't have that extra confirmation, like a 20-day moving average coming up underneath us, or some sort of rising channel of key support or resistance, maybe a 20, 50, 200 period moving average could be one of several of the majors, then I want to go ahead and actually wait for 7 bars. And that way, if it goes ahead and doesn't touch for over 7 bars, so here we got 1, 2, 3, 4, 5, 6, 7, 8, 9. We've got lots of bars here before we ever touch this level. Then when it gets down there, I'm going to go ahead and assume that the support is going to hold and look for long side trades in that area. Okay, let's look at another example here to help illustrate the point. Okay, so here we go ahead and have bonds. And with the bonds, what you'll see here is that we went ahead and last year we had a lot of resistance up above us, and we kept trying to break through this key long-term resistance area. We kept hitting it. You see we closed above it for 1 day, and then the next day it would come right off, for instance, right over here. So 2-bar break? No. Then we came over here, we'd trade above that resistance a couple of bars, actually lock in distribution there, roll right over. Come right back up here, trade to it, roll right down. Come up, go ahead and trade 1 bar to it, 1 bar through it, and then roll right back down. So we didn't get the 2-bar break through here. Same thing here. Same thing here. We trade to it, couldn't get through it. All right. So as we fast forward here back into time, now look what happens. Now all of a sudden we finally go ahead and break through, right? We go ahead and pursue 1 bar, but we don't have a 2-bar consecutive break. All right, so now what I'm looking for here is to go ahead and get 5 to 7 bars. All right, so we have 1 bar here, 2, 3, 4, 5. Okay, now, if after that 5th bar, if it were to come right back down and I have rising support here as it's coming back down, then I'm still going to be willing to take that trade. Now, if this 20-day moving average wasn't so close, let's say it was way down here, then I would insist upon the extra 2 days there, so making it 7 bars. And then if it came back down to this level and the 20-day wasn't there, then I go ahead and be willing to take the trade anyways. So that's where the 5 to 7 bar difference goes and comes in. 5 bars if you've got very important key daily support coming in here, if it's a daily chart you're working with. Otherwise, if you don't have that support, then 7 days. All right, so as we go ahead and we fast forward here, kind of look at this into time, you'll notice that after the 5 to 7 bars, it went in and was clearly support. All right, so what happens, we come down here, and eventually what will happen is this area will ultimately be touched, and there it is. That long-term support level, the resistance level that became support, then went ahead and we came right down to that level, and you'll notice how it was rejected right off of there. So you're looking for those long side trades right in that area. From my perspective, the way we want to look at this is really from a risk-reward perspective as well. How far do we go ahead and have an opportunity to bounce back up before hitting major resistance versus what happens if we fail here? So that kind of helps determine the risk and reward, the number of ticks down below if we were to fail to hold that area that we'd want to go ahead and take a stop versus the anticipated reward if we're correct on the trade. Okay, and while it is a high probability trade from my perspective, you still have to determine your risk and reward basis in advance on this. All right, and so as we're looking at this, you place an order down here at the key support. You're expecting it to go up X number of ticks. You want to go ahead then and make sure that your risk reward stays proportionate there. So if you think it's going to go up this much, you wouldn't want to risk more than that to the downside at a minimum, even if it's a high probability trade. So you might want to go ahead and tighten that up even tighter. And for instance, here you got the rising 200-day moving average. Can't imagine if all is right with the world here with this chart, there's no reason that this should be coming down to or through the 200-day moving average right now after this being the first test going months out since the break. That thing should hold. That's a very high probability trade from my perspective. So even as we go forward here, so here we are, now you see we've come crashing right back into that level. So from my perspective here, not even going forward yet, as I look at this, that we've not only hit that key level again, but now you're hitting that rising 200-day moving average. So you've got a confluence of support there. It shouldn't be going much beyond that, a very small percentage beyond that, and yet you can see the major resistance is up here. So there's a great opportunity up to here, but there's no reason to risk much more than this 200-day moving average, because if it's going through that key support and that 200-day moving average, something's wrong. So we're going to go ahead and just look and see what kind of happens here, and you see we went ahead and kind of bounced off there again. So this is just kind of an example of how to go ahead and use this 2-bar break system initially. The 2-bar, of course, allows us to be much more active, much more quicker, but if it doesn't give the 2 bars, then how we use the 5 to 7 bar technique to go ahead and determine that something is in fact now support or resistance, so that when we get back down to those areas, we can expect bounces from them. Okay, so I hope you enjoy that tool, because that can be a great tool to be used with underlying equities or certainly options when you're not expecting it to go down any further. For instance, you expect to find key support here. You can always be a seller of puts as an example, as one strategy here, or if you're going ahead and vice versa, if this were a resistance level that we're coming back up to, you don't expect to go any higher, you can sell some calls. Lots of different tools and techniques, both on the options side and of course the underlying instrument side, whether it be futures or stocks for that matter, that you can use with this technique. So I hope you enjoy it, and we'll look forward to seeing you in the next video. If for some reason you're picking up this video series later in the series, or you're not getting them in your nightly email, what you might want to do is go ahead and go over to becomeabettertrader.com, so www.becomeabettertrader.com, and go ahead and what you could do, if there wasn't a little box that popped up when you first came to the website, you can always go ahead and sign up right over here on the far right hand side, or you can go ahead and move right over here to where it says Rob's free videos, and that should help you find some of those great videos that you're looking for there. Okay, and look forward to going ahead and using these videos also to announce other opportunities for you to come watch some of the stuff live in the live trading room, come to different types of webinar events that I do educationally, where you guys could talk to me and interact with me live. Okay, so you guys have a great day, and I'll look forward to seeing each and every one of you in the next special professional series trading video here. Take care, everyone.